CMHC has capped 600 billion in insurance money, and they're currently probably 550 billion. And what's going to happen, or what's the implication when they hit that 600 billion to the Canadian consumer?
I think there's probably two issues to address on that. I think the first is that CMHC and through the government really does need to look at increasing that cap. That's an absolute must in mind.
They've done it before. You think they're going to do it again?
And there's a reason behind that. I think what we've seen is through a lot of the sort of monoline lenders, every deal that goes through is getting insured through bulk insurance in order to be securitized.
Right.
What that means is we've got mortgages in there that are 25% loan to value, proven income on a client with an 800 beacon. Really, that mortgage does not need to be insured.
Correct.
In my mind, it's a waste of that limit to insure that mortgage. So what we need to do is also look at the investors and get them to recognize that putting an insurance policy on a mortgage that's at 25% loan to value is not necessary. And so if we can get the investors to understand that and say, okay, maybe we only need to have bulk insurance on deals that are over 65% loan to value. That's going to save a lot of costs for those monoline lenders, but it's also going to create some room as we go forward by not creating a redundant insurance policy that doesn't do anything. The risk of loss on a 25% loan to value mortgage really is zero.
Okay.
So,
and the flip side of that is think about how much additional revenue CMHC collects to deal with this so-called potential concerns they might have about the level of mortgage debt and its effect on default. I mean, they're collecting so much more revenue just as a result of being involved in the securitization model of the mortgage business.
So it's really also about making the investor feel confident and comfortable, perhaps with an alternative insurer.
Well, I think that's the key thing, is that if you look at where the cap is, I mean, first and foremost, I think to answer Holly's questions, if the cap does get hit this year, it's going to have major implications on the marketplace.
Right.
I think we could all agree on that part of it. It is going to have some real implications, and especially for non-traditional bank lenders. But even the banks are going to have implications. This is the key thing I think that brokers have to understand, is that it's not just the monolines that'll be affected by the cap. It'll be the TDs, the RBCs, the Scotias. They're all going to be very affected. So the banks themselves are very invested to make sure that either the cap gets raised or they stay under that guideline. In addition to that, but the other insurers, Genworth has come out already and said that they have enough money for the rest of this year. Canada Guarantee has come out and already said that they have enough funds. So I don't think, as far as for the consumer, at this point in time, it will not affect the consumer at all. What it may affect is definitely the lenders in the future, their ability to get the funds, but it's going to affect all lenders. It's not just going to affect the monolines.
Do you think it would perhaps the government might entertain doing 100% guarantee on Genworth and Canada Guarantee? I think they're only at 90% now versus the 100% for CMHC. Do you think that's ever going to
no.
No.
I don't think so.
There might be a conflict of interest there. I don't know.
I don't think so.